Hello students, myself is Parminder Singh from Prab Kripa classes. Our today's topic is Money Magic, Decoding, Fractional Reserve Banking. After going through this course, the students will understand what is the meaning of fractional reserve banking, why do commercial banks need to hold reserves in fractional reserve banking, whether separate ratio is assigned for cash and funds at central bank in the fractional reserve banking system. Normally what happens when we go to the bank and say deposit $1,000, the banks have to comply with the reserve requirement which has been fixed by the central bank. Thus, say reserve requirement is 10%, the banks keep 10% and they give $900 on loan. So now we will understand whether this reserve requirement is further subdivided into how much percentage should be in cash, how much percentage should be in funds which are to be parked with central bank, whether separate ratio is fixed where the total is this. Now how the fractional reserve banking works, this $900 is again treated as deposit and it is again given on loan after keeping fractional reserve. We will understand all this. The students will also understand, do commercial banks have the authority to produce physical currency, or the authority to produce physical currency rests with the central bank, which in case of United States it's Federal Reserve, or in the case of India it is Reserve Bank of India. Now the students will also understand, why do most countries grant the central bank the sole legal power to issue physical cash? It means that why physical cash is only issued by the central bank in most countries. The students will understand who is responsible for the production of physical currency in India. What is the situation? What is the scenario as regards to India so far as the physical currency production is concerned? How do commercial banks generally acquire physical cash to meet their operational needs, to feed the ATMs or provide cash to the teller services? Now the topic before us is fractional reserve banking, a simple definition and overview. Fractional reserve banking is a banking system in which commercial banks are required to keep only a fraction, a portion or a percentage of their customers' deposits as reserves and lend out the rest. This is the simple definition of fractional reserve banking. It means that when we deposit some money in the banks keep certain percentage of the same with them, or with or some portion with central bank, and the rest amount and the balance amount is used for lending purposes. The reserve requirement in fractional reserve banking usually includes both cash by the commercial bank and fund kept in the accounts at central bank. Now we will understand the meaning of fractional reserve banking in reality. Suppose you go to the bank and deposit, say, $100 in the bank. The banks are under the supervision of a big bank which is known as central bank. All the banks have to comply with the directions of the central bank, and as per the directives of the central bank, certain percentage of the deposit, each deposit has to be kept aside, which is in the form of cash, or some percentage may be deposited with the central bank. So some portion has to be kept aside. Suppose we assume that reserve ratio as fixed by the central bank is 10%. So here the banks will keep 10% of this initial amount, initial deposit, that is $1,000. 10% means $100 the bank will keep aside as reserves. Then the banks will lend out the balance loans to someone, say another person B, because initial deposit was $1,000 and after keeping 10% reserves, the banks have given loan of $900 to a person B. You also know that usually the banks do not give the money in cash. If you ask for loan, they will not give you hard currency, physical notes or coins. They will usually deposit that amount which has been given to you in the shape of loan. They will create a deposit in your name. So the amount is deposited in the name of B. So it becomes deposit. Deposit becomes $900, which was given loan. It has taken the shape of a deposit. So now the bank will again use that deposit to give loan. Here again, the bank will keep aside 10% as reserves. So now the bank will be in a position to advance a loan of $810 to another person C. As already told, banks do not give money in cash. So again, this money gets deposited in the same bank in the name of C. So now the banks are again in a position to keep 10% of this $810 and 90% of 810, that is $729, will be given on loan to person D. So this process goes on. This is fractional reserve banking, that is on the basis of the initial deposit, some reserve is kept aside and the balance is given on loan. This loan takes the shape of deposit and again after keeping 10% or the reserve ratio aside, the balance is again given on loan. So this process goes on. It is naturally, this question may naturally arise in your mind that in this way the banks may create lakhs of dollars when the initial deposit is simply $1,000. No, it is not so. We will certainly find a answer to that. How much money can be created by the commercial bank on an initial deposit? We will find an answer to this in the coming videos. So this all is fractional reserve banking. Fractional reserve means keeping a fraction the initial deposits as reserves and then lend out the balance and again redepositing and again giving loans. Now the topic before us is the logic of reserves, exploring their significance in fractional reserve banking. The question means that if say we deposit say rupees, say $1,000 in the bank, the banks have to keep some portion of the deposits as reserves, say 10%. 10% is reserve requirement. Now the banks are in a position to lend $900. Now the question is, why the commercial banks keep 10% or whatever ratio is fixed by the central bank. Why these reserves are kept by the commercial banks? Why the banks do not give all this deposit, all the deposits which are available with them as loan? Why do not they give all? So now we will again read the question. Why do commercial banks need to hold reserves in fractional reserve banking, or what is the purpose of reserve requirements in fractional reserve banking system? As you know that whenever a deposit is created or deposit comes in the bank, the banks keep a certain percentage of the same as reserves, and they may use the balance amount to give loans to the customers or to make investments. Now the question is, who fixes the reserve requirement? This reserve ratio or the reserve requirement is fixed by the central bank, which in case of USA is Federal Reserve, and in the case of India it is Reserve Bank of India. So now we will find out the answer for keeping reserves. First is to meet withdrawal demands. Now, when a large number of customers, say one has deposited $1,000, another may have deposited $100, another may have deposited $50, some may have deposited $2,000. So, when there are thousands of customers in each bank, they might require the said money at some point in time. If I have deposited, say, $1,000 in the bank, after 2 months or 3 months, it is quite possible that I will need the same, or the other customer may require the same, say after 10 days, say after 6 months. No, the banks cannot guess when the customer will come. So, to meet the withdrawal demands of the customers, the banks have to keep reserves with them so that they are in a position to meet the withdrawal demands of the customers. It is not that the customer comes and the banks have given all the deposit as loans and they are not having anything in cash available with them. So these reserves are set aside to ensure that the bank can meet withdrawal demands from its depositors and maintain a certain level of liquidity and stability. Next is to prevent bank from making too many loans. The reserve requirement prevents banks from generating too much money by making too many loans against a narrow deposit base. As already told, that when initial deposit of say $1,000 is made and the reserve ratio is say 10%, it may change from country to country. Then the banks are in a position to give $900 as loan. If say this reserve requirement is not there, then the banks will be in a position to give all this amount initial deposit as loan, and again this amount will get deposited and again they will give it on loan. So they will be in a position to give too much loans against this initial base, because this amount will again get redeposited and again they will give loan of $1,000 if there is no reserve requirement, and this process will go on, continuously go on, and on a very narrow deposit base of say $1,000 they will be in a position to give large number of loans. So next point is tool for controlling money supply. Reserve requirements are a tool for controlling money supply. The central banks have the authority to increase or decrease reserve requirement. This reserve ratio is fixed by the central bank in each and every country. They have the authority to fix it. on the basis of the market conditions, whether they want money supply to increase or money supply to decrease, they increase or decrease the reserve ratio. If they increase the reserve ratio, say it becomes 10 to 20%, they increase, what will be in a position, what will be the position? Then on the basis of 1000 deposits, the banks will be in a position to lend only $800 because reserve ratio is 20%. So market supply, money supply will decrease if the reserve ratio is increased. If the reserve ratio is decreased, say it is decreased to 5%, so the banks will be in a position to lend $95, $950. So the money supply will increase. So if on the basis of the increase or decrease of money supply, it will impact the interest rates, inflation, and overall economic activity. We will discuss all these points in the coming videos. Next is help by central bank in exceptional situations. We have already told you that when a deposit comes to a bank, the commercial bank has to keep a fraction of those deposits as reserves. These reserves are in the shape of cash. When a deposit comes, some percentage is kept as reserve ratio. This reserve ratio may be in the form of cash kept in the bank, and some amount is kept in the central bank account. Some amount is kept in cash and some amount is kept in the accounts of the central bank. So it may be situation that sometimes there are a large number of customers which come to a bank and start withdrawing their money. It may be on the basis of some rumor that the bank is likely to fall or likely to become bankrupt. There may be rumor in the market, so the large number of customers will come to the bank to withdraw money. So in that cases, the central bank will use this amount which is deposited by the commercial banks with the central bank. They will use this amount to give money to the commercial banks so that they can meet the withdrawal demands of the customers. So this amount will be given to the commercial banks in the case of extraordinary situations when large number of depositors come to the bank to withdraw money, or in the case of bank run. Bank run means when the large number of customers come to withdraw their money. Reserve requirements can vary from one country to another. It may be quite possible that in one country the reserve ratio is 10%, in another country it may be possible that it is only 5%, in some countries it may be 4%. It depends on the central bank of the country to fix the reserve ratio, and they can also change over time. It is not that once fixed they will not change it. The central bank keeps on changing or will keep it fixed. It is the prerogative of the central bank to keep it as it is or to change, increase or decrease as per the economic conditions of the country within a country based on the monetary policy objectives of the central bank. Now the topic before us is central bank reserves versus physical cash. Separate ratios in fractional reserve banking. Whether separate ratio is assigned for cash and for funds at central bank in fractional reserve banking system. We will first understand the question, what the question is. We have already learned that in the case of fractional reserve banking, if say $1,000 is deposited in the bank, the banks have to keep a certain percentage or a certain fraction of these deposits as reserves. In the shape of reserves, they have to kept aside some amount as kept aside. Suppose the reserve ratio is 10%. We have already learned that this reserve ratio is fixed by the central bank of the country, and each commercial bank has to comply with the same. So now, when the initial deposit is $1,000, banks have kept the reserves of 10%, and now they will give the balance amount of $900 on loan. They can give, they how much they give, it depends on that banks. However, they are in a position to give $900 on loan because it is 90% which has been kept for loans after keeping 10% aside. Now the question arises, this reserve consists of two parts. One is some amount has to be kept as cash by the bank, and some amount of this reserves has to be kept in the central bank funds. In other words, we can say that this amount belongs to central bank and the commercial bank cannot use it. Or so this reserve consists of two parts: cash plus central bank funds, funds which are to be parked with the central bank. So now the question arises, how much percentage of is cash out of this 10%? How much reserve is cash? How much amount of this reserves is central bank? Whether it is 2% cash or 8% central bank or 8% cash or 2%. Now this is the question. How much percentage of the reserves is cash and how much percentage of the reserves belongs to central bank funds? So we will find the answer. While it is possible in that the fractional reserve banking system can define separate reserve ratios for physical cash and central bank account funds, it means that central bank has the authority to decide how much amount will be kept in the reserves. They also have the authority, that is the central bank also had the authority to decide how much percentage will be kept in cash and how much percentage will be kept in the funds of the central bank. They can decide, but it is not a common practice. Usually it is not done by the central bank, though they can do it. Usually they give the overall limit, that is cash plus funds at central bank at all should meet a specific criteria, that is say 10%. Both these amounts, cash plus funds at central bank, both should together constitute the reserve ratio amount which is fixed by the central bank. Usually there is no breakdown between the cash portion and the central bank account portion. The reserve requirement is typically expressed as a single percentage of the total customer deposits. Suppose we assume that there are say $100 $1 lakh in deposit with a particular bank. Now the banks are say required to keep the reserve requirement of say 5%. Now the banks will keep only $500 as reserves and they will be in a position to lend out $95,000. So here the reserve requirement is expressed only as a percentage of the total customer deposit. It usually does not break down how much to be kept in cash, how much to be kept in central banks accounts. This reserve requirement applies to a combination of cash and central bank account funds. The goal is to ensure that bank as a whole maintains the required total reserves. It means that overall, the central bank only wants that 10% has to be kept aside. Say 10%. This is a ratio which has been fixed. That amount should be kept aside either as cash or at the central bank. The main purpose is that specific amount should be kept aside. However, the exact rules and practices may differ from country to country and regulatory authority. From each country to country, this practice may differ. The central bank may or may not decide or differentiate between what amount should be kept in cash and what amount should be kept at the central bank funds. Now the topic before us is fractional reserve banking in action. How banks multiply deposits. Fractional reserve banking works by allowing banks to hold only a small portion of the customer's deposits as reserves, while the banks can use the remaining amount to make loans or investments. It means that whenever a customer deposits, say rupees 100 in a bank, the banks have to keep a certain percentage as reserves, and the balance amount they can use as for the purpose of giving loans or investments. This fractional reserve system allows banks to create money and facilitate economic activity. We will understand the same with the help of an example. A customer goes to a bank and deposits, say, $1,000 in the bank. The reserve requirement which has been fixed by the central bank is, say, 10%. So the banks will have to keep 10% of this $1,000 as reserves. That is, the banks will be required to keep the reserve of $100. Now, what is the position? This is the deposit of $1,000. Now, the banks have to keep reserve ratio is 10%. Say it is 10%. That is, they will have to keep aside $100 as reserves. Now the banks are in a position to lend out the balance, that is $900 as loan to another customer, say B customer. When the bank issues the loan to this customer B, this is the customer A who deposits $1,000. Now the loan is being given to B customer. Now the full amount has not been given as loan. Some amount has been kept aside, balance has been given on loan. So when this loan has been given, it must be understood that the banks do not usually give it in cash or in hard currency, physical notes or coins. They usually create a deposit. This amount takes the shape of deposit in the name of B. So a deposit is created in the name of B of the amount of $900. So you will see that these two deposits start existing in the bank. First is $1,000 and another $900. Both these deposits, this one and this one, coexist at the same time. This increases the money supply in the economy. That is, both these customers A and B can utilize these $1,900 if they wish to use the same. So the money supply stands increased in the economy. Now, if the borrower of the loan can now spend that money to purchase goods and pay off debts, the amount spent by the borrower or money received by the recipient gets deposited in another bank. We will understand the same. Suppose now this amount is deposited in the name of B. So it is possible that this customer purchases some building from customer C, from a person named C, and this whole amount is given as purchase money. Now the seller C has received this $900. So this C will deposit it in another bank, say bank X. So when this loan amount of $900 has been given to another person in for purchasing a particular building, now this amount again gets deposited in some another bank X. So now the deposit of another bank increases by $900. Now that bank again will keep 10% as reserves, and they will be in a position to give a loan of $810. So this process goes on. The second bank in turn can lend out a portion of the new deposit, creating even more money. This is often referred to as money multiplier effect. This process of lending and redepositing goes on, leading to expansion of money supply in the economy. So in this way, deposit comes to the bank, banks give on loan, this amount again gets deposited, banks again give loan by keeping some portion as reserves. This process goes on and the money supply increases in the economy. However, a point is to be noted that banks cannot create indefinite money from this initial deposit. It is important to note that actual money creation process can be more complex and depends on various factors. It means that it is not that banks can create indefinite money on their own whims. That is, they can say create $1 lakh from simply initial deposit of $1,000. It is not say. The creation of the money by the banks depends on various factors, including reserve requirements. If the reserve requirement fixed by the central bank increases, the banks cannot lend more. If reserve requirement decreases, banks are in a position to lend more. It also depends on consumer behavior. If the customers do not want to borrow, then to whom the bank will give loan, and the willingness of the banks to lend. If the banks think that the customers may not return the money, then it or the market situation is not proper and it may not get the money in return back. So if the management of the banks thinks that they should not give much loan or should use various techniques to ensure that their initial loan does not get swindled by the unscrupulous persons, so it may decide that they should give loan very after proper verification. They may hold their strings while giving loans. So but the basic concept remains the same. So though the banks give loans and create money supply, or they create money in the economy, but this action of giving loans and increasing money supply is affected by many factors. Sometimes a question may come in the exam whether commercial banks make money or create money out of thin air. This is a very important question, whether banks create money out of thin air. So while this statement of banks making money out of thin air sounds sensational, interesting, captivating, and arousing curiosity, it looks Nice. It looks interesting to note that banks create money out of thin air. On an initial deposit, they are increasing money supply. They are creating how much? Many times money. They may create indefinite money. However, it is more accurate to say that banks create new money through the process of fractional reserve banking, primarily by lending money. They create money, but they create money by the process of lending. New money is not created out of thin air. Banks cannot create an unlimited amount of money. It means that suppose there is $1,000 as initial deposits, it is not possible that they can create a money of say $100,000. They cannot create so much money. There are restrictions. There is a concept of money multiplier. We will read it after some time. Banks cannot create an unlimited amount of money. They are constrained by reserve requirement and other regulations. There are many regulations which the commercial banks have to follow. So the banks do not create money out of thin air. They cannot create an unlimited amount of money. Now the topic before us is currency issuance authority, central bank versus commercial banks. Who can produce physical money? Today, when we want to buy something, we try that we should not be required to go to the market. We open some online site, Amazon or some other site, and place order online. And for the payment, we use our debit card, credit card, or internet banking. But sometimes our debit card does not work, credit card does not work, and we may have to opt for cash on delivery. Sometimes we go to the market and want to purchase something. Your debit card may not work, and you may have to give him currency, bank notes or coins. Now the question is, who produces bank notes, physical notes which you use for purchasing something? Who prints, who produces these? Who has the authority to produce these banknotes, this physical currency? Do commercial banks have the authority to produce physical currency, or is that power solely held by the central bank? In each and every country, there are large number of commercial banks which are in private sector or public sector or in cooperative sector. But above all, there is a central bank which controls the functioning of or regulates the functioning of all the banks. In India, it is the Reserve Bank of India, and in USA, it is Federal Reserve. So the answer is commercial banks do not have the authority to create physical currency. In India, we have 10 rupee note, 50 rupee note, 100 rupee, 500 rupee. These notes are not created or produced by commercial banks, or the banknotes and the coins are not created by the commercial banks. Only the central bank, which in India is Reserve Bank of India, has the legal authority to issue physical cash in most countries. Central bank in most countries of the world has the authority to produce physical currency, that is the banknotes and coins are mostly produced by the central bank in most countries. In United States, for instance, central bank is the Federal Reserve, which is responsible for the production and distribution of paper currency and coins. Commercial banks create money, but in the form of bank deposits through a process called fractional reserve banking. When a person deposits an amount with the banks keep a certain portion of that, a certain fraction of that deposit as reserves, and they give balance money on loan to some other customer. And as you know, the banks do not give loan in cash. They create a deposit in the name of the borrower, and in this way again a deposit is created, and the banks are again in a position to lend money against that deposit after keeping the a fraction of that deposit. The money created by commercial banks is in digital or electronic form. It is not the same as creating physical cash, that is physical banknotes and coins. That is, when they create deposit, they usually credit the amount to the account of the borrower. They do not give money in cash. They create deposit in digital form in the account of the borrower. Physical currency is generally produced by government printing or minting facilities, and physical currency is distributed through central bank to the commercial banks as needed to meet the demand for cash in the economy. So physical currency is normally printed by the government printing press or government minting facilities in the case of coins, and these physical notes and coins are distributed to the commercial banks through central bank. This helps control the money supply and maintain the stability of the currency. So while commercial banks can create digital forms of money through lending and deposit activities, that is through fractional reserve banking, the banks create money in the form of digital form. The creation of physical cash is actually the exclusive responsibility of the central bank. Now the another question is, why do most countries grant the central bank the sole legal power to issue physical cash? It means that why in most countries only central bank has been authorized to produce physical cash? Why many authorities are not authorized to issue physical cash? Next question is the same question in another way is, what is the underlying reason for the central banks having the exclusive legal authority to issue physical currency in most countries? The answer is to ensure physical that to ensure that the currency supply is stable. That is, where the supply is required, the central bank will ensure its supply to prevent for counterfeiting and fraud. If a large number of authorities or large number of institutions are authorized to print, there may be some problem, because it may be quite possible that the paper quality will be different in case of each institution. Some type of ink problem may be there while printing notes, or in such a scenario where large number of institutions are authorized to produce currency, physical currency, the chances of fraud and producing a illegal currency may chances of producing illegal currency or chances of fraud increase. Another reason for granting the sole legal power to central bank to issue physical cash is to prevent excessive or irresponsible money creation by other entities. It may also be possible that if many authorities are authorized to produce physical currency, then some persons may go on printing, go on producing large number of physical coins or physical banknotes. They may do so. So to keep a proper supply, to ensure proper supply of the physical banknotes and coins, the central bank in each country is mostly authorized to produce the physical cash to promote public confidence in the currency's value. So these are the reasons why the central bank is authorized in most countries to issue physical cash. Now the topic before us is currency crafting in India, the Reserve Bank's role in rupee manufacturing. Whenever we go to the market to purchase something, we may use our debit card, credit card, or internet banking. When we opt for online shopping, in the same way, we can use our debit card, credit card, or internet banking. We can also opt for cash on delivery. So when we opt for cash on delivery, or when we go to the shopkeeper and we give him currency notes or coins, the question revolves around that. What is the role of Reserve Bank of India in rupee manufacturing? As you know that in India, the central bank is Reserve Bank of India. So the central bank, so the Reserve Bank of India is authorized or has the legal authority in India to produce physical currency. So we will now concentrate on this role of Reserve Bank of India and will try to get more knowledge about the same. Who is responsible for the production of physical currency in India? It is Reserve Bank of India. The Reserve Bank of India estimates the demand for physical cash in the economy. How much physical cash is required in the economy? The RBI makes estimate of it, and on the basis of its estimates, the RBI places orders with two subsidiaries or the two organizations of the Government of India, which are namely Security Printing and Minting Corporation of India Limited and Bharatiya Reserve Bank Note Mudran Private Limited for the production of new banknotes. RBI places order with these two government institutions for the production of new banknotes. When the banknotes are produced or printed by these two organizations, the RBI distributes these new banknotes to the commercial banks and other financial institutions. When we use banknotes, some notes outlive their life, they become mutilated, or so here the RBI withdraws old and damaged banknotes from circulation. Now they do not directly receive the same from the public. You can deposit your old and damaged banknotes with your commercial bank, and the commercial bank will return the same to the Reserve Bank of India, so that these damaged and old banknotes become out of circulation. They are no longer used, and the RBI will again print new notes in place of that. However, you will get the new notes on the spot from the commercial banks. RBI also has the authority to mint coins, but RBI does not produce coins directly. Again, RBI places the order with Government of India for the minting of coins. For the purpose of minting of coins, the Government of India has 4 mints in India at different places. RBI places order with those mints, 4 mints, which are owned by the Government of India, and when these coins are minted by the minting facilities, then RBI distributes that coins to the commercial banks and other financial institutions. So in this way, you will understand that RBI has the main role to play in to ensure the proper supply of banknotes and to ensure the proper production and distribution of physical currency in India. Now the topic before us is funding the vault, how commercial banks secure physical cash for everyday operations. First of all, we must understand what the question means. Suppose we have a deposit with our bank and we go to the bank and want to withdraw, say, $1,000. Now another customer goes to the bank and wants to withdraw, say, $10,000. Now another customer goes and he wants to draw, say, $20,000, and so on. A large number of customers come to the bank and want their money because they require the same in cash. So now the question arises, from where the banks get cash to give it to their customers. So when these are the customers who have come to the bank for withdrawal, there are other customers also, like businessmen, who have money with them which they have obtained from their customers, and they will deposit it with their banks. So many customers may come, say X comes and he deposits, say, $1,000. Another customer may come and he may deposit, say, $500. Another customer may come and he deposits $20,000. So in this way, on one side the persons come for withdrawal, on the other side there are many persons who come to the banks daily to deposit some money. It is not that the same customer repeat. Customers may differ from day to day. Some are routine customers, some businessmen or some individuals who deposit cash money into the bank so that they can make use of their internet banking or etc., or to use that amount later. However, it may also be possible that this deposit comes less and more customers come for withdrawal. This amount is cash. Withdrawal is more than deposit on a particular day. Suppose the persons come for withdrawal of, say, $1 lakh, and say banks have only $10,000. We are assuming it only for example purpose. So in that case, if there are large number of customers which come to the bank and the banks are not in a position to get bank cash from anywhere, the banks can approach the central bank, that is the Reserve Bank of India in India, which is the central bank in India, main bank. So now we will understand this question. What is the question? How commercial banks typically acquire physical cash to meet their operational needs, including supplying ATMs and providing teller services to the customers. Commercial banks can acquire physical cash through customer deposits when customers bring cash to the bank and deposit it into their accounts. Banks can also obtain physical cash from the central bank to meet the demand for cash in their operations, such as supplying ATMs and teller services to their customers. You have already learnt that one of the reasons behind fixing the reserve ratio, that is, as you already know, that some amount of the reserves is kept as reserves, and out of these reserves some may be kept at the bank as cash and some amount may be deposited with the central bank funds. So this fund which is saved or deposited with the central bank may be used or may be asked for by the commercial banks from the central bank in case of emergency, when there are bank runs or other, the central bank comes to the help of the commercial banks so that the financial so that the confidence of the public in a particular bank is not shaken. The central bank comes to the help of the commercial bank in case the commercial bank asks for the help. That is why the commercial bank central bank is also known as lender of last resort. We will also learn about the same later on. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.